Good evening, everybody. Madam Mukesh, Mr. Bandare, Mr. Rawat Singh, Mr. Sraf, Mrs. Pai, and from the audience, my gurus, Mr. Bagai, Mr. Tarapur, Ms. Gopinath, and all the friends who are us, including my wife. A very warm good evening to you once again. At the outset, let me pleasure at being here today with you on this occasion, MR Pai Memorial Lecture. It is my proud honor I have presented the MR Pai Memorial Award to Madam Udeshi, former Deputy Governor, Reserve Bank of India, and former Chairperson, Banking Boards and Standards Board of India. It is normal for to be presenting awards and prizes to the students, but it is a strange thing for a student to present an award to his teacher. The MR Pai Foundation has caused that to happen. As young boys and girls, I am sure many of you, like me, would have dreamed to present awards and prizes to the teachers. Today, thanks to the MR Pai Foundation and the Depositors Association, my such day has become a reality. Srimati Udeshi has mentored to me and to many more in the Reserve Bank of India. Her charming disposition and dedication, her staunch principles and high values and varied knowledge and experience. She had been a well-respected coach and mentor, also a strict disciplinarian. Having a sportsperson, she knew the value of playing by rules, the importance of fair play. That definitely helped her being a strict disciplinarian. She was in the Reserve Bank and during her tenure as the first chairperson of the BCSBI. I am very grateful to you, Madam, for giving the privilege and honor of honoring you. Thank you very much. As is well known, Sri MR Pai was a multifaceted personality, but his greatest contribution lay in starting the consumer movement in India. He was active in all areas and confronted monopolistic giants like the telephone service, the Indian Airlines, and more particularly the banks. Title of Champion of the Consumers. The consumer protection, consumer activism has come a long way since those times. The best example of this is in what the Financial Legislative Reform Commission has said in their report in 2013, which Madam Udeshi was also a member. I quote, consumer protection. A prime motivation of all financial institutions is to protect consumers. The relationship between financial and their customers is one where many times outcomes may harm customers. These problems are sporadic or accidental, but are often rooted in problems of information and incentives and will not be alleviated through financial literacy campaigns. The central purpose of regulation is to intervene in the relationship between firms and their customers and address market failures. This requires a comprehensive consumer protection that covers both the problem of prevention and cure. Unquote. I am sure this is music for the great Pai. I will be discussing the essential elements of for consumer protection as well as the initiatives taken globally and in India with specific reference to the Reserve Bank of India and consumer protection. Protection of the interest of the depositors has been one of the mandates of the Reserve Bank. The Banking Regulation Act 1949 is with the phrases like in the interest of depositors whenever it entrusts powers to the Reserve Bank. Granting of a banking license or cancellation thereof, actions are on advances or on any banking matter, applying for suspension, winding up or amalgamation of, approving appointment of CEOs or additional directors of CEOs, all these are to be exercised, keeping things the depositors' interest in perspective. But the services provided by the banking sector today are much more than only deposit services. This rapid is in the nature of financial services as highlighted for robust regulation as well as consumer education, protect and empower the consumers. The need to extend of banking services to underserved sections of the whose financial literacy is low, combined with the growing of financial products and the use of technology, can increase the risk of mis-selling. Financial consumer protection should be and integrated with other financial inclusion litigation efforts. If such protection is as the benefits of the economic growth of the expanded inclusion may be severely hampered. Financial consumer protection also contributes to strengthening financial stability. Taking these factors into account, Reserve Bank has recently articulated its core purpose, values and vision, commitment to the nation to include regulating markets under its ambit to ensure financial stability and consumer protection. In the Reserve Bank of India, the government has also been the financial consumer protection. As I said, the finance has given several recommendations with regard to consumer. The Reserve Bank has welcomed these suggestions, this approach to consumer protection. The draft IFSC is currently examination. International. Globally, several initiatives have been taken for protection by both the international standard setting bodies and the regulators. Regarding initiatives taken by the standard setting, the G20 requested the OECD and the FSB and others to articulate principles on financial protection. These broadly state that financial protection should be an integral part of the legal, regulatory and supervisory framework, and there should be equitable treatment of consumers with special attention dedicated to the needs of the vulnerable groups. It should include adequate compliance handling and redress mechanism, accessible, affordable, independent, fair, accountable, timely and efficient. The G20 and World Task Force on Financial Consumer Protection is currently focused on supporting the implementation of their high-level principles. The is working on how to enhance financial consumer protection, which includes determining what is required to help consumers gain the confidence, knowledge, information, security, and choices they need to enable them to fully participate in financial markets. In 2011, the Financial Stability Board published its report on consumer financial protection, with particular focus on credit. Nations have taken specific initiatives. For example, USA, the Dodd-Frank Wall Street Reform and Consumer Protection of 2010, it has created the Consumer Financial Protection Bureau to protect consumers by carrying out federal consumer financial laws. In the United Kingdom, the Financial Services Act of 2012, the Financial Conduct Authority supervises banks to ensure that customers fairly and encourages innovation and competition. In the European Union, the European Banking Authority promotes a transparent, simple and fair internal market for consumers in financial products and services. The EBA fosters consumer protection in financial services through its union. In Hong Kong, the industry the Code of Banking Practice promotes good banking practices by setting out the minimum standards which financial institutions should follow in their dealings with the customers. And in India, consumer protection has been an ongoing effort by the Government of India. For greater effectiveness and a more focused approach, several committees were appointed on aspects of customer service in banks from time to time, including the Alwar Committee in 1975, the Koiporia Committee in 1990, the Tarapur Committee in 2004, the Sadasivam Working Group in 2006, and the Damodaran Committee in 2010. The importance of consumer protection was also highlighted in the Committee on Financial Sector Reforms chaired by our Dr. Raghuram Rajan. The RBI had a banking ombudsman scheme to act as a visible and dispute resolution agency for common persons utilizing banking services and to ensure redress of grievances of banking services in an inexpensive, expeditious and fair manner. There are several initiatives which, as I said, the Reserve Bank has been taking continuously. In the last year also, several measures we have taken. One related to, we released our of customer rights. So we are in the process of fully effective in the banks, and we have taken series of measures to simplify know your customer related regulations and to transparency in pricing of credit based on recommendations of working group. We have directed the banks to display on their website inter alia the interest rate contracted loans for the past quarter for different of advances granted to individual borrowers, along with the mean rates for such loans. The total fees and charges on various types of loans to individual borrowers has been directed to be disclosed. Page key fact statement fact sheet was also available to all borrowers. The as regards products also, when the banks sell the products to customers, the suitability of the products have to be clear in their mind before they undertake that activity, and will advise to treat their customers fairly, honestly, and transparently. In the interest of time, I am skipping several initiatives taken. Let me come to the. I understand that in many depositors, several questions linger, and they eagerly avoid the response. Actually, it is not that they seek from the Reserve Bank of India. Rather, they want rationale behind and the explanation for actions and some non-actions. It is our duty. Let me discuss some of these contemporary issues. The question. Deposit insurance. The issue that I want to discuss relates to the deposit insurance. Specifically, the issue relating to increasing the limit on deposit insurance. Deposit insurance protects depositors against the loss of their deposits in case a deposit is not able to meet its obligation to the insured. In India, the commercial banks, the regional, rural, local area banks, and the cooperative banks are covered by deposit insurance. There has been a persistent demand from and public representatives in the recent past hike in deposit insurance cover from the current level of 1. The deposit insurance system around the world evolved over time by reforms adopted by various jurisdictions based on experience, international developments, guidance from supranational bodies like the IMF, the International Association of Deposit Insurers, and other changes from time to time. One of the basic principles of deposit insurance is that the deposit insurance system cover at least 80% of the deposit accounts and 30% of the total accessible deposit. In India, we have surpassed this norm in a substantial way. As on March end 2015, ACGC's deposit insurance covers as high as 9.3% of the deposit accounts and 31% of accessible deposits. Therefore, before on this demand, we have to factor in two major issues. One, the moral hazard issue, and the risk-based premium issue. Deposit insurance inherently creates a moral hazard. That is, the parties insurance, that is a bank, and its insured depositors get an incentive to take more risk because the cost of the risk in whole or in part are borne by generally a deposit insurance agency, is the DACGC. Most deposit insurances initially adopt an ex-ante flat rate system because they are relatively simple to design and administer. However, these systems were in that they do not reflect the risk that the banks pose to the deposit insurances. Flat rate premium systems have also been viewed as being unfair, as low risk banks are required to pay the premium as high risk banks. With no inbuilt incentive for high risk banks to improve their risk, a flat rate system would accentuate the moral problem. Therefore, the primary objective of most commercial premium systems has been to provide incentives for banks to avoid excessive taking, minimize moral hazard, and introduce more fairness into the premium assessment process. Introducing fairness system bolsters industry support for deposit. A hike in cover without calibrating the premium to the risk profile of the insured banks only accelerates the moral hazard. Recognizing this, a committee on the premium system for banks in India has been constituted by the ACGC and actually has submitted its report yesterday. We hope that introduction of risk premium system will make ground for considering raising the from the present ceiling of rupees 1 lakh. Second issue. You have noticed that recently granted in-principle licenses to 11 entities from payment banks in the country, and several of you nurture a vague feeling about how these differentiated banks will serve consumers' interest. I want to explain to you how we have carefully structured the regulatory arrangement of these banks from the perspective of consumer protection. You will recall, consequent to the discussion paper Banking Structure in India, the way forward, brought out by the Reserve Bank of 2013, and as by the committee headed by Sri Nachiket More on financial services for small businesses and low income, to look into the issues relating to financial income. In November 2014, we announced our intention to grant licenses to two types of differentiated banks. One, the payment banks, and two, the small finance. The objective of setting up payment banks will be further financial inclusion. The strategies will be providing small saving accounts, payments and remittances to migrant labor, low-income households, small businesses, and other unregulated, unorganized sectors of the economy. The scope of the permitted for the payment banks included acceptance of deposits. Payment banks will initially be restricted to holding a maximum balance of rupees 1 lakh per individual customer, issuance of ATM and debit cards, and payments and remittance services. Deposit collected by them can be only in the current savings bank account. They cannot accept fixed deposits. These payment banks are prohibited from lending activities. They can deploy the deposits largely government securities only. A small portion, up to 5% of their deposit, can be held in deposits with us. The consumer protection aspects of the design are as: one, the public deposits in the payment system covered by the deposit insurance of the DICGC. Deposit ceiling of rupees 1 lakh and the deposit insurance is also rupees 1 lakh. It means that the depositors of the payment banks will be fully insured. There were arguments why payment banks should be covered under deposit insurance when their assets will be fully in high quality liquid assets, securities and high credit bank accounts. Still, concluded that such an assurance as deposit insurance is needed for the depositors of payment banks. The concept is new and the depositors will need additional funds. As the payment banks may operate in remote areas mostly through BCs, ATMs and other, the payment banks will be required to have at least 20% of their physical access points in BCs in rural areas. Further, we require a controlling office for a cluster of access should also be established for control over various and customer grievance redressal. We have ensured that the bank should have a high-powered customer grievance to handle customer complaints. The payment banks will also be under the purview of RBI's banking ombudsman. Now let me explain the advice we adopted for granting in-principle license. I want to emphasize here that granting banking license is not a tick box exercise. It needs to be based on high regulatory comfort about the fit and proper position of those who will manage the bank. Further, the bank high leverage organizations and whose they actually leverage public assets. Should we not require highest degree of about the entities with whom public monies can be invested? Will this not actually mean we set in our guidelines the licenses shall be issued on a very selective basis? The licensing authority has to apply its mind and exercise. To do this, we had multiple layers of checks so that the exercise is not arbitrary. Actually, we had 5 layers of assessment. The first round was the preliminary scrutiny by staff based on eligibility criteria. The second round was a detailed analysis of the application by our staff after information collection, including from various agencies. The third round was by an external committee comprising people of high integrity expertise. The fourth round by the internal committee, the governor and the deputy governors sat and decided. Finally, in the fifth round, by the committee of the Central Reserve Bank of India. Thus, we had taken extreme care that before approving any authorization for a bank. We are convinced that our decision to adopt such a approach in licensing of payment banks in the initial phase is very prudent and sound. Another that we have taken is to keep intact the difference in authorizing financial service providers versus licensing financial product purveyors. The financial service providers do not deal in the customer's money. They only render broking, agency, and advisory services to their customers, whereas the product service purveyors like the banks, funds, and insurance companies actually receive monies from customers and manage their monies. This handling of public monies need a totally different regulatory approach compared to handling of servicing the customers through agency or advisory function. That is why prudential regulations on the former are much more stringent than the conduct regulations on the latter. It follows that while the liberal authorization may be possible in the case of service providers, cautious authorizations will be needed in the case of authorizations of. We have also announced that we will license finance banks, another new set of differentiators. The objective of setting up small finance banks, payment banks, is also to further financial inclusion. However, it is sought to be achieved through a different set of strategies. One, provision of savings vehicles primarily to unserved and underserved sections of the population, and two, supply of credit to small business units, small and marginal farmers, micro and small industries, other unorganized sectors entities through technology, low-cost operations. The small finance, in furtherance of the objectives for which it will be set up, shall primarily undertake basic banking activities, acceptance of deposits and lending to underserved sections, including, as I said, small units, etc. It can also undertake other non-risk sharing, simple financial services, not requiring any commitment of their own funds, such as distribution of mutual funds units, in products, pension products, etc. The guidelines for the small finance banks have also been tweaked. It will be required to extend 70% of its adjusted net bank credit to the sector eligible for classification as priority sector. The maximum loan size and investment limit exposure to a single and group obligor be restricted to 10% and 15% of its capital. Further, in order to ensure that the bank loans primarily to small borrowers, at least 50% of its loan portfolio should constitute loans advances of up to rupees 25 lakhs only. Customer protection requirement in view, we have prescribed the small finance bank should have high-powered customer grievance cell to handle customer complaints. The small finance bank will come under the purview of RBI's Banking Ombudsman scheme. We have received 72 applications and are in the final stages of determining who all can be licenses. At the cost of repetition, I want to say here also that the granting of banking license to small finance bank is also not a tick box exercise and will be extremely costly before the right persons to be given that. Third issue, market development and customer protection. As regulators, we face the dilemma of market development or market innovations versus customer protection. Still a developing and emerging market. While in several respects we have reached international standards, still quite a sizable segments in the financial sector that needs development and innovations. Financial inclusion is a case in point. New ideas need to be encouraged. Initial cost, which will be typically needs to be recovered. Initial period and failures need adequate return and compensation. On the other hand, these compulsions will mitigate against customer protection. As regulators recognize this dilemma, we did face this dilemma in recent years in the cases of microfinance institutions, the ATMs, credit and debit cards, the electronic transfer services like the RTGS and NEFT, and even the cash services. We were convinced of the need for expansion of these services and services. We understood the trade-off between the charge for these services and the customer's interest. Our approach has been a gradual move from facilitating entrenchment of such developments and innovations by ensuring competition and choices for customers, a fairer treatment of consumers and fair charges. Life in low interest rates. Now I would like to the scenario that will emerge in our country in the next few years and some preparations that all of us savers would be undertaking, would need to undertake. For a very long period, most in our own living memory of the post-independence, India had been going through high inflation period. Of course, thankfully, we never had hyperinflationary periods like in several African and South American countries. But certainly, our experience of inflation was in high single digits to teens, and hence inflationary expectations were very well entrenched. Though we experienced low inflationary levels in some periods, we could not sustain it. For at another time, now experiencing low levels of inflation, it is amply clear that this time around we will be able to sustain it for the years to come. The monetary policy framework agreement that we have with the government prescribes that the objectives of monetary policy will be to maintain the consumer inflation 4 plus or minus 2%. It gives the necessary assurance and confidence to put inflationary expectations at bay. It is to note that influential thinkers have now about recession than about inflation. This low inflationary period entails for the savers. For one thing, they will realize that the real value of savings is higher and remains preserved and protected. In periods of low inflation, the real value of money does not change much. However, they will find that the nominal interest rate that they receive will be low as compared interest rate that they enjoyed during the high inflation. After all, the simple formula for determining interest rate is nominal interest rate equals real interest rate plus rate of inflation. As the real interest rate in any economy will be more or less constant, the nominal interest rate is directly proportional to the rate of inflation. Thus, it will rise when the rate of inflation increases and fall when the rate of inflation falls. Informed may get worried. It may give rise to an illusion. More specifically, in case of those who live on fixed interest income, as if their income levels have come down. It is not so. Actually, their low nominal interest income will now command better goods and services as the real value of savings and incomes have been preserved. As business and consumer confidence will be and better during low inflationary levels, consumers will have higher appetite for risk taking. This will mean less reliance on pure interest rate income. Before investing, savers will buy various financial of capital market for appropriate risk reward combination. Savers will increasingly need and need the services of financial advisors and to help them decide investment. This is what we must all be prepared for. Let me once again recall what the uncommon man, that is Sri M.R. Pai exposed. In his words, most Indians are ignorant of their rights and are therefore taken for a ride. As regulators, we are conscious of this position. That is why we constantly pay our closer attention on financial consumer protection, more specifically the protection of the vulnerable, defenseless customers. Thank you very much for your attention.